Welcome back to the channel, where we help you understand the complex world of finance, breaking down market opportunities and risks. Today, we're diving deep into a specific stock that has landed on our hard-to-borrow screener, TGHL. We'll explore why this microcap company has an eye-popping cost-to-borrow fee and what that could mean or not mean for potential short squeeze dynamics. But before we get started, please remember, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show TGHL stock chart, if available, otherwise just logo/text. Today, we're focusing on TGHL, a microcap stock that has recently caught our attention due to some very unusual borrow rates. Our data currently lists TGHL's sector as N/A. The estimated float for TGHL stands at 12.7 million shares. Now, before we dive into the fascinating world of short squeezes, let's address some critical recent market data for TGHL. Over the last 30 days, TGHL has seen zero price change, sitting at plus 0.0% today, and identically over the last 5 and 30-day periods. Even more striking, the daily volume for TGHL is currently at 0 shares, with a 30-day average volume also registering 0. This means its relative volume is 0x its average. We'll discuss the profound implications of this zero activity shortly. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? At its simplest, if you want to short a stock, you first need to borrow shares. Brokers facilitate this, but they charge a fee, the cost to borrow, or CTB. This isn't a one-time charge, it's an annualized rate calculated daily based on the value of the shares you've borrowed. When a stock becomes hard to borrow, it means there are very few shares available to loan out, or the demand to borrow those shares is extremely high. This scarcity drives the cost to borrow through the roof. Think of it like renting a car during a major holiday. Prices skyrocket because everyone wants one, and supply is limited. For short sellers, a high CTB means their conviction has to be incredibly strong to justify the daily cost of staying in the short position, which can quickly erode any potential profits. Why this stock is hard to borrow right now. Highlight CTB number. Now let's look at TGHL specifically. Our data shows a staggering annualized cost to borrow fee for TGHL at an incredible 773.1%. That's not a typo, over 773%. This means that short sellers holding a position in TGHL would theoretically be paying an astronomical amount to maintain that borrow on an annualized basis. While the exact number of shares currently available to borrow is unknown from our data, a CTB fee this high strongly suggests extreme scarcity in the borrowable float, estimated at 12.7 million shares. For a short seller, this kind of CTB acts like a ticking time bomb, constantly eating into their capital and increasing the pressure on them to cover their position. Squeeze mechanics explained. So, how does this high cost to borrow tie into short squeeze? When a stock is heavily shorted and the cost to borrow becomes prohibitively expensive, short sellers face immense pressure. If the stock price then starts to rise, even slightly, it creates a squeeze. Short sellers, facing mounting losses from the rise in price and the high daily borrow fees, might be forced to buy back shares to close their short positions. This buying pressure, often referred to as covering, further drives up the stock price, creating a domino effect where more shorts are forced to cover, fueling an even stronger price surge. It's a powerful feedback loop where buying begets more buying, often leading to rapid and dramatic price increases. Dilution risk check. Show text, no recent dilutionary filings. One critical factor that can make or break a short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the value of existing shares and can completely negate any upward momentum from a short squeeze. For example, if a company with high cost to borrow simply issues millions of new shares into the market, it provides an ample supply for short sellers to cover their positions without driving up the price, or worse, can cause the price to drop significantly. This is why we always check for recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424BS. For TGHL, we have found no recent dilutive SEC filings in the last 90 days, nor any recent reverse splits. This is a positive checkmark in the context of a squeeze potential, meaning the company hasn't recently added a float of new shares that could satisfy short covering demand. Just a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show squeeze score 46.5. Now let's tie it all together for TGHL. We have an incredibly high cost to borrow, 773.1%, and no apparent dilution risk, which typically are key ingredients for a potential short squeeze. Our internal composite squeeze score for TGHL, which combines factors like CTB, borrow supply, float size, and momentum, sits at a moderate 46.5 out of 100. However, it is absolutely critical to look beyond just the cost to borrow data and score. TGHL has traded 0 shares today, and its 30-day average volume also sits at 0. Its price action has been similarly flat with no change today, over the last 5 days, or even the last 30 days. This means that while TGHL might technically be hard to borrow, there's currently no active market, no trading interest, and therefore, no discernible price momentum for a short squeeze to even begin to materialize. High CTB alone does not guarantee a squeeze. It can also indicate that short sellers have strong conviction and are willing to pay the high fees, or, as appears to be the case here, that the stock is simply dormant and illiquid. For any squeeze scenario to unfold with TGHL, you would need to see a dramatic return of liquidity and genuine buying interest. TGHL presents a fascinating, albeit complex case study. On one hand, its astronomically high cost to borrow of 773.1% and clear dilution risk check are the kind of data points that typically flag a stock for short squeeze potential. On the other hand, a complete absence of trading volume and price movement over an extended period tells a story of extreme liquidity. Without buyers and sellers actively trading shares, even the highest borrow fees won't trigger a squeeze. This highlights why it's crucial to analyze all available data, not just one metric, and understand the full picture before making any investment decisions. What are your thoughts on TGHL and its unique situation? Let us know in the comments below. If you found this explanation helpful, please hit the like button, subscribe for more in-depth financial education, and share this video with anyone looking to better understand how to borrow stocks and short squeezes. Thanks for watching, and we'll see you in the next one.